Welcome back. So we're moving from a very important topic, geopolitical risk, to another equally relevant topic, which is heterogeneity in the economy, particularly across households. We have today here, I'm Fiorella de Fiore, I'm research advisor at the BIS, and we have Antonella Trigari from Bocconi University, Anna Rogantini Picco from the ECB, Christina Molnar from Norwegian School of Economics, and Morgana Richard from Science Pool. So the first paper will be presented by Antonella. The floor is yours.
Thank you, Fiorella. Okay. This here is better. Okay, good. So thanks a lot for the invitation. Thanks for being here. It's a pleasure to be again at this conference. I really enjoy the atmosphere, and I think it's really an important initiative. So first of all, let me say that this is very much work in progress. So I look forward to your comments, and I should also apologize and thank in advance before seeing the discussion to my discussant, because she had to work on slides, and I'm not sure whether to call it a draft, but some very preliminary draft. Okay, so this is going to be a paper about fiscal policy, aggregate demand, and with a focus on labor reallocation. So let me tell you what is our starting point, or was our starting point, even if we're changing a little bit the focus as we learn while working on the paper. So the first fact is that economies are characterized by substantial labor reallocation across sectors. And what we mean by labor reallocation is reallocation of job seekers, so unemployed workers who move across sectors, so substantial search mobility. The second fact is that sectors are quite heterogeneous in several important dimensions. The first one is their labor market outcomes and conditions, and in particular unemployment risk, and the associated and the extent actually of insurance against this associated risk. At the same time, sectors are also different in terms of their exposure and influence on other sectors in the aggregate economy, because they differ in terms of the incidence of shocks and in their position in demand and production networks. So as a result of these two facts, it's going to be the case that shocks and policies are going to have heterogeneous effect across sectors. These heterogeneous effects are going to be transmitted and propagated through sectoral linkages of various types. And importantly, I say importantly because this is the focus of this paper, these effects are going to be mediated by reallocation of workers across sectors. Now, I'll tell you now what we do or what we plan to do in certain dimensions, and I'll dig a little bit deeper on why we do it. So we first document in the United States, across the last 2 decades, labor reallocation and sectoral heterogeneity across a number of dimensions, and in particular to document extent and cyclicality of labor reallocation, we are going to construct some new indices of gross labor reallocation. We then, and this is ongoing work, estimate the impact of countercyclical fiscal policy. In particular, think about unemployment insurance extensions during the Great Recession or COVID, or firm subsidies, for example, PPP, the Paycheck Protection Program during COVID, on labor reallocation, as well as on aggregate unemployment, both directly and through reallocation. We develop a multi-sector new Keynesian model with heterogeneous agents, so incomplete markets and idiosyncratic risk, the hang component, search and matching frictions, the sum component, which is going to importantly render unemployment risk endogenous, an input-output network we will have sectoral heterogeneity across all these dimensions, plus we will allow for endogenous reallocation of job seekers across sectors. We then and this is, to our knowledge, this is the first model that combines this element into a tractable, and that's very important, framework. We then calibrate the model to US data, and we use the model to study the effect of countercyclical fiscal policy on reallocation and employment, and to connect the results we get from the model through counterfactuals to the model predictions, to the empirical estimates that are actually in progress. Okay, so why we do it? So the first reason why we do it is to address recent changes in the nature of shocks and the associated policy responses. Economists have experienced, and this has been emerging in this conference quite importantly, an increasing prevalence of asymmetric shocks. So sectoral shocks, think about pandemic, trade, energy, climate, artificial intelligence. Now, these shocks are going to cause uneven labor displacement across sectors, and this is going to make labor reallocation a central adjustment mechanism. In particular, this is going to depend also on the persistence of the shock. Now, yet, the counter-cyclical policy responses, they are rarely conditioned on sectoral heterogeneity or the incidence of the shocks. If you think about monetary policy, it remains largely untargeted. And fiscal policy, and here I'm thinking a little bit about the US versus Euro area debate after COVID, they're mostly focusing on whether they should target households with transfer or firms with subsidies. Now, the second reason why we do this exercise, and in particular we build this model, is that we want to study how labor reallocation shapes the transmission of shocks and the effectiveness of policy. And to do that, we want to capture, so here I'm going to justify the Hank sum and the Hank IO part of the model. We want to capture two key mechanisms of amplifications that are associated to aggregate demand effects, and that are at the same time going to interact with labor reallocation. The first one is a feedback loop that emerges in Hank sum framework between aggregate demand and endogenous unemployment risk. So the idea is that if a shock causes an increase in unemployment risk, then this is going to prompt higher precautionary savings motives. This is going to reduce aggregate demand, consumptions and aggregate demand, and in presence of nominal frictions, this is going to cause firms to respond in this setup by posting fewer vacancies, and this behavior is going to further increase unemployment risk through a feedback loop that amplify the initial effect of the shock. Now, this mechanism is going to interact with reallocation through a number of channels, and here I'm pointing to two important channels that are related to this paper. One is a compositional channel and one is a within sector channel, because as workers move in response to a sectoral shock, from the heat sector, say, to other sector not hit directly by the shock, then there are going to be compositional effects associated to the fact that these sectors are heterogeneous, and in particular, some sector might provide better insurance than other sectors to unemployment risk. At the same time, there are going to be within sector effect, because this reallocation is going to change conditions within sectors. It's going to change, for example, is going to reduce the unemployment risk in those sectors that are seeing workers leave, and it's going to because the job finding rates of the remaining workers are going to increase, and it's going to increase risk in the receiving sectors. The second aggregate demand amplification mechanism that we want to have in the model is the Hank AO part. Here, the amplification arises from the interaction between aggregate demand and the IO component. The idea being that a sectoral shocks that causes, say, a reduction in demand in a given sector is going to cause a cascade of effects because every good uses other goods as intermediate inputs, and so demand is going to be diminishing in other sectors that at the same time use the final output of the original sectors through a cascade of amplification effect. And here, in the interest of time, but also because for now we focus more on the other mechanism, I'm going to skip a detailed description, but again, we have compositional effects and within sector effect that are going to be associated with reallocation. So I'm going to skip the related literature, except that I want to emphasize how we relate to the first strand of the literature, which is about sectoral shock and reallocation. So this literature has emerged from the seminal work of Lillian, 1982, where the idea was that economists have some desired reallocation because they are subject to idiosyncratic structural sectoral shocks that imply that factors, capital and labor, should move across sectors. Now, because there are frictions, this movement is time-consuming and costly. In particular, this movement is going to cause unemployment because it takes time for this worker to move. So reallocation causes unemployment. Here, instead of focusing, the focus is very different because instead of focusing on desired reallocation, we focus on the role of realized reallocation. So the idea is to try to understand how realized reallocation, actual movement of workers across sectors, is going to mediate the effect of shocks. Okay, so let me, so I'll briefly show you some evidence, a sketch of the model, and then an application to unemployment insurance. Okay, so first of all, what we do, we use CPS longitudinally linked data to measure what we call realized reallocation. So basically, we have data on new hires across sectors, and we also have data on the last sector of employment before the unemployment spell. So, and here you see these are the sector of last employment, and here are the sectors where workers find jobs. And we estimate substantial reallocation because on average, 48% of job finders find a job in a sector that is different from their previous one. We also consider a different type of reallocation of job seekers. So this is trying to understand how job seekers change their sector of search, which is obviously not observed. We don't have this information in standard data set. We don't see something as sector unemployment. So what we do, we propose a new method that is going to use both data and model. So we build a dynamic equation, a recursive equation for the stock of searchers in each sectors, and which is going to depend on the inflows and the outflows, and then we use available data together with estimated job finding rates by sector to estimate this probability that a worker who was searching in transportation and utility in a given month is searching in the same sector or instead is searching in a different sectors. And also, according to this measure, we find that there is substantial reallocation. 32% of job seekers switch sectors, switch the sectors in which they search each month. Now, we then want to make sure that this reallocation has some cyclical component, as otherwise our question would not be interesting. So we look at the evolution of these of two indexes that are based on these matrices, and we find that they are quite cyclical. In particular, they decline during major recessions. This is true for the realized reallocation and for the search-based reallocation. So finally and briefly, we look at heterogeneity in terms of unemployment risk and consumption insurance. So here you see a scatter plot where you have the unemployment rate, and we use both last employment before the unemployment spell and the search-based unemployment measure. And on the vertical axis, you have the consumption ratio, which is our measure of consumption insurance. So the ratio of consumption of unemployed workers to employed workers across sectors. And so what's the message from this figure is that there is substantial heterogeneity, but also that there is a negative correlation among these two characteristics, so which implies that sectors that are more exposed to unemployment risk, they're also going to be less insured against it. Okay, so the model so let me switch to the model. So the model builds on some previous work I have, and I forgot to mention my co-author at the very beginning, I think, so Alexey, Gorn, and Nicolò Rizzotti. So the starting point is a tractable Hank-Sam model, where basically what we do through some household structure and intra-period borrowing with employment-specific liquidity constraint, we allow for incomplete markets and idiosyncratic risk. Importantly, idiosyncratic risk is endogenous, leading to this amplification loop that I was mentioning. To this baseline setup, what do we add? We add multiple ex-ante heterogeneous sectors, input-output linkages, and sectoral reallocation, where through a family construct, we are going to, the model is going to imply gross reallocation across sectors. So to do that, of course, we need to introduce some randomness, because workers are going to move to, because that's what we observe in the data. When we look at gross flow, we see that workers move between sectors even when the value of searching in that sector might be the same or even lower. So we introduce some randomness, as in the trade literature, through taste shocks. So basically, this is the structure of the Hank-Sam model. And so we have a labor market that is characterized by search and matching frictions, where households and firms are going to interact. Households are going to be characterized by incomplete markets, consumption inequality in a tractable way. And then we have firms, and so what I should emphasize, we have three types of firms. So basically, if you think about the well-known New Keynesian Dixit-Stiglitz type of structure, we have an additional layer. Why we do have this additional layer? These wholesale firms that post vacancies, because we want to separate the price-setting decisions to the vacancy posting decision for tractability reason. This is something that has been done since the literature has been doing this. And finally, we have a government that sets counter-cyclical policy, fiscal policy. Now, here that's our setup. So to the Hank-Sam, so first of all, we have multi-sectors, sector I and sector J. Why these are important? Because they are ex-ante heterogeneous. And second, because they define local labor markets. So they define where workers and firms are searching. And how are these sectors linked? They are linked, first of all, through labor reallocations. So workers who are unemployed, they are going to move across sectors. And they are also linked to an IO, network. And in particular, you see here that the retailers, who in the one sector model, they only buy, they only use output from wholesale firms, which basically is labor. We should think of this as labor. Now, retailers are going also to use intermediate inputs, so they use a bundle of intermediate inputs, and so these generate the links. And we also have, of course, households who consumes a bundle of final goods. This is, in this kind of work, this is one key slide, but I'm going to skip it in the interest of time, and just mentioning that we use sectoral labor market stock and flows, household and firm level sectoral targets to calibrate the model. And in particular, we need to calibrate moving costs across sectors, and we do it by using the search-based reallocation matrix, and we estimate the costs of moving across sectors that are consistent with the observed flows. So how much time do we have? Perfect. So here that's the last part of the paper in the current form. So we try to see what the model says about how reallocation is going to shape the transmission of shocks first, and then the effects of countercyclical policy. And in particular, we think about unemployment insurance policy. So let me just describe the exercise that we are going to implement. So first of all, we're going to consider sector-specific separation shocks. And the reason we focus on this is that this is a shock that is a very natural interpretation in our framework because it directly affects one key margin, which is unemployment risk, that is going to be interacting with aggregate demand and with reallocation. We calibrate the sector-specific shock to generate a 1% increase in aggregate unemployment because we want to abstract, at least at this stage of the analysis, from differential incidence of the shock. And we're going to focus to think about the effect on the response of unemployment, and both the aggregate unemployment and the sector-specific unemployment rates. We will look at countercyclical UI policy, and for now, we have an untargeted policy. So this is going to be countercyclical UI policies that is homogeneous across sectors. In ongoing work, we are thinking about targeted policies of different types. And we look at three sectors economy, so two are ad hoc economy, so we want to provide a benchmark, so we have a symmetric economy, so we calibrate three sectors to the aggregate economy, and we assume a symmetric input-output network. Then what we do, we just introduce one dimension of heterogeneity, which is going to be consumption insurance. So one sector, sector 2, is going to either have lower or higher consumption insurance. And you might ask why you should consider lower and higher. Isn't this symmetric? No, this is not going to be symmetric because one insight that we derive from this preliminary analysis is that actually the direction of reallocation is going to be key. So what kind of sector are shedding workers and what kind of sectors are actually receiving workers. And finally, we check that the results also hold in a fully calibrated economy. We have 10 sectors, but here to sort of make the results a little bit more salient, we pull together similar sectors, and we have a three-sector calibration with goods producing, low-skilled services, and high-skilled services. Okay, so here it's the case of symmetric sectors. On the first plot, you see the response of aggregate unemployment to a separation, so there is higher separation in sector 2. Here you see the sectoral responses in terms of unemployment rate. So these are the unemployment rate of the three sectors in different colors. And it's always going to be the case in this exercise, so let's remind it that the solid line denotes the case where we allow for reallocation, while the dashed line is the case where we don't allow for reallocation, so that we can see the effect of reallocation. So the first message is that there is propagation. Of course, because we have an input-output network and we have also demand linkages. So even in the case of no reallocation, the dashed line, you see that the sectors that are not hit directly are going to see an increase in their unemployment rate. Second, and now let's compare the dashed line to the solid line in this second plot, reallocation is going to lower the dispersion of unemployment, which is intuitive, right? As some workers are going to move from the hit sector to the not hit sector. However, we don't see any effects of reallocation on the aggregate unemployment rate. Why is this the case? This is because of symmetry. That's why this is our benchmark. So workers are moving across identical sectors, so there is no effect from composition. But at the same time, the within sector effect, so changing in conditions within sectors are going to be there, but they're going to be exactly offsetting each other. Now, we then look at policy, and okay, I'll take 30 seconds more. We then look at counter-cyclical policy, and here you see the effect on aggregate unemployment. So the message is policy is counter-cyclical. That's not obvious in our model because we have both positive aggregate demand, stabilizing aggregate demand effect, and destabilizing distortionary labor market effects. But the effect of the policy, when you compare the no-reallocation to the reallocation case, they are exactly the same. So policy doesn't make anything to the effectiveness, reallocation doesn't make anything to the effectiveness of fiscal policy. Now, we move, and then these are the last two slides I want to show, we move to the asymmetric case. So first of all, here reallocation is going to have an effect, and in particular, reallocation is going to be stabilizing. And the reason why reallocation is stabilizing in this case, it's a very important reason, is that the heat shock is the shock with lower consumption insurance. So basically, as workers move from low insurance sectors to high insurance sector, there are going to be positive aggregate demand effect associated to this reallocation coming from both compositional effect and within sector effect. Now, what about policies? How does policy interact with reallocation? And here the results is a little bit surprising. So even though the highest stabilization emerges when you have both policy and reallocation, actually reallocation is going to dampen the effectiveness of policy. And the reason is that policy is going to have differential effect across sectors because it's going to be more valuable in the low insurance sectors. And because of this differential effect, policy is going to dampen reallocation, and by dampening reallocation is also going to reduce the positive effect that comes with reallocation. And finally, we confirm our results in the calibrated three sectors economy. So this is a list of what's next, but in the interest of time, I'm going to leave the floor to Anna. Let me take the glass so that you don't take my glass.
Thank you. The discussant is Anna Rogantini Picco from the
Thank you.
Thank you.
So thanks a lot for having organized yet another We Are In conference. I've been participating since the very first online edition, and I think it's really an amazing opportunity for youngish economists like me. So thanks again for inviting me to discuss Antonella's paper. Let me first tell you why you should read this paper once there is a first draft. Could I get the, no, it's here, the clicker. Okay, sorry. So this is a super quick review of the last 5 years. So in 2020, we were hit by COVID pandemic. Then the war in Ukraine broke out, and we had an energy price shock to face. Then the second term of Trump came, and now we are, as we've been talking a lot earlier on, we've been dealing with trade wars, tariffs, and sanctions. Underlying this, we are facing climate change for already now some time, and this is something that is here to stay, if not getting worse. And then yesterday, we also discussed quite a lot about AI. We're at the beginning of a revolution. So why did I go through this? To just quickly illustrate the complex world we are living in, and the fact that our economies are really hit by shocks which have very different natures. Some are health, political, energy, so very different nature. They have a very different incidence in our economies and across sectors. And they hit sectors which are heterogeneous to begin with. On top, we are trying to craft policies to face these shocks. And these policies often are not targeted to specific sectors. Like, for example, the many fiscal packages were maybe targeting some groups of households or firms, but not really one sector or the other. Or more generally, like monetary policy, they're targeting aggregates rather than specific sectors. So why you should read Antonella's paper and her co-authors, of course. It provides a very comprehensive but still tractable model. It seems an oxymoron, but it's not in their case. They manage to really have the main features that allow them to quantify all the layers of heterogeneity, in particular to look at the propagation of shocks and the efficacy of policies. So what are these main ingredients that they retain to study this propagation? So the first channel is a hang sum, so heterogeneous agent, Neo-Keynesian model, so with price rigidities, and with frictional labor markets. And this gives rise to a feedback loop between aggregate demand and unemployment risk. So you have a shock hitting a sector, unemployment risk goes up. Because there are heterogeneous agents, they engage in precautionary saving, and so they save more, consume less, demand drops, and unemployment risk goes up, and you have like firms post less vacancies, and so you have this feedback loop. So this is captured by the hang sum part. On top, there is another channel which is coming from the hang input-output, so network structure on the production side. And this also generates an additional feedback loop between aggregate demand and the network structure. Of course, the strength is going to depend on the centrality of the firm sector hit in the network. But in any case, there is this propagation effect. The third channel is coming from labor reallocation, which is really the focus of the paper. So on top of the other two, you have labor reallocation, which interacts with the aggregate demand mechanism that I just mentioned. And this labor reallocation, what is interesting is that it can either amplify or dampen the effects of the shocks and policies, depending on the direction in which this reallocation happens. So this is very interesting. And just to recap the main quantitative results so far are the following. So when you have a sector-specific separation shock, what happens with labor reallocation? Labor allocation is going to be stabilizing unemployment if it hits a sector that has low consumption insurance. Why? Because people are going to move out of that sector into a high consumption insurance sector, and so this lowers unemployment. Instead, it amplifies unemployment if it hits a sector with high consumption insurance, because then people move towards a low consumption insurance, and so their unemployment goes up. A similar asymmetry happens because of policies. So it's not just shock propagation, but also how policies interact with the shock. And in particular, Antonella has talked about unemployment insurance extensions. These are less stabilizing if they hit a sector with low consumption insurance, because people stick around more in that sector, and so the benefits of reallocating labor to another sector go down, and on the contrary, it's more stabilizing if the shock hits a sector with high consumption insurance. Okay, so to recap, both there is a change in the composition of employment and the consumption across sectors, which is going to alter aggregate demand and propagation of shocks. So now I have three main thoughts. The first concerns the concept of labor reallocation. In the paper, they have a very clever way to construct this search-based reallocation index, because in the data we don't see really where people search, job seekers search. We only see the job finding rate and the job separation. So they estimate this first day sector-specific job finding rate, and then they use a recursive equation to describe how job seekers move, the stock of job seekers move from one sector to the other. So what I was thinking is that this could be extended. So at the moment, they assume that searchers only search in one sector, but I think that it's more like if I have a given skill, I search in all sectors where there is my occupation. So I would allow for this margin, so to search in multiple sectors at the same time, and maybe the dynamics would change. Secondly, there is another very important margin that has emerged from the literature, which is the on-the-job search. So there are flows going from employment to employment, not just from unemployment to employment. And I think that especially given that the focus is really on labor reallocation, it would be really interesting to also incorporate on-the-job searchers and not just focusing on unemployment. Thirdly, now they really focus on heterogeneity across sectors, but there could be heterogeneity across skill, which is also relevant, and people trying to move from one type of skill to another, especially if we think of shocks like AI, where some type of occupation can be really kicked out in a sense. So I think this could be another additional margin to look at, so heterogeneity across skills. The second comment that I have is on the type of shock that they look at. So in the motivation, we bunch together different types of shocks. Some are more cyclical, like COVID, that has persistent effects, but it was more like cyclical, and others are more structural, like the AI revolution or climate change. And at the moment, the analysis really catered towards the more cyclical shocks. So they look at a temporary separation in one, like an increase in the separation rate in one sector. But I think that the model is very encompassing, and because of really the structure that they have, they could speak towards more structural shocks as well. In particular, for example, if I think of the AI revolution, they could consider like a shutting down of a whole sector, or really a change in the input-output structure, and how this would affect the reallocation and the propagation of shocks. And my third and last comment is which policies they're looking at, but Antonella have already mentioned that, so now they're looking at untargeted unemployment insurance extensions, but of course it would be interesting to look at targeted policies to a specific sector. And in addition to that, not just looking at like what type of agents, not just policies targeted to sectors, but to also different agents, like firms versus workers, or really looking at matches, like policies that retain the match between employer and employee. And finally, but this might be maybe the next paper, would be to look at a more normative side, because of course now they're trying to gauge quantitatively the effects of policies and shocks looking at past shocks and running counterfactuals, but precisely because labor reallocation and policies might either dampen or amplify the effect of the shocks. I think thinking of what would be the optimal policy could be really interesting. So it's a very ambitious project, still a tractable model, and they look at how reallocation mediates the propagation of shocks and policy role. Okay, thank you.
Would you like to respond?
Yes. So thanks, Anna, for this very nice discussion. I'll borrow all of your suggestions, but some of your slides as well, because they are very nice. So let me answer in a little bit in random order. So in terms of the policy, yes, that's exactly what we want to think of, targeted policy, firms versus sector. Hiring, subsidy, job retention scheme, this is really important if you want to address the European response, job retention schemes to COVID versus, ensuring versus the unemployment extension response in the United States. This should we insure the job or should we insure the worker? There is a technical aspect that we need to have endogenous separation if we want to think about job retention schemes. So it's a little bit easier to think about the hiring incentives then. Now, in terms, okay, so I think this point of on-the-job search is actually, that's another, extension which might be demanding technically, but it's really important because, so why we focus on unemployment searchers? Because there are a lot of new eyes from other jobs. I myself have worked on that. So the job ladder is really important. But the idea is that it's uncontroversial that unemployment risk is important for aggregate demand, and that policies actually, many fiscal policies, that's what they target, right? Unemployment. But there is a literature, and it's an emerging literature, and I have two students, actually, PhD students working on that, that they argue that idiosyncratic risk also comes from moving up the ladder. So the risk that this ladder is going to weaken or is going to break, in a cyclical manner during recession is a risk that should be incorporated, and it's going to interact with aggregate demand. And actually, there are no policies that address that risk that is emerging as an important margin. Now, in terms of occupation,
if you want to keep some time.
Very quickly, in terms of occupation versus sectors, yes, I'll be super quick. It's really important. We are working on this. So what is a local labor market? It's occupation, it's sectors, it's the interaction of the two, and so we are working hard on this. The type of shocks, I think one benefit of this framework is that we can actually think of supply and demand shocks. In terms of supply shock, so the focus is on demand, but basically if, all the more structural shock that you have mentioned would still have a transitional period and would generate a recession, then we would have something to say about that and how reallocation would shape this, whether we would want quick or a more rapid, a more gradual reallocation to get to the new steady state. Thanks a lot.
Thank you. So we have a few minutes for questions. Beatriz
González from Banco de España. So thank you very much. It was super interesting. So I wanted to ask about the hang part of the model, because you talked a lot about fiscal policy, but you have this side with nominal rigidities, with monetary policy that you're not looking at. And I think it's very interesting. First, why do we need this hang part? So you explained that it gives like this extra feedback loop, but what would we be missing if we don't have that part? I think this would be super interesting to compare this to the flex price economy and having these price rigidities. And also having this, I mean, I don't know if for this project or another one, I would be very interested in seeing what are maybe the side effects of monetary policy now that you have here, no? So we know that monetary policy is not intended for this side, but it might have effects through all these channels that you're exploring in this paper. So I think it would be something super interesting to understand. Thank you.
Thank you, thank you. Should I?
Any other, maybe we collect the questions and then
Let me write it.
So, Carolina Villegas, two very small points. So I thought that maybe like a cross-validation of the nice exercise that you do with this new way of the labor reallocation might be to look at job postings, that there are like big data sets that allow you to basically classify like job postings by sector. And the other thing that I thought is, in this literature of like I/O and networks, I mean the centrality, right, and maybe connected to Anna's point, like the type of shock connected to the centrality of the sector in the economy. So that might have like bigger effect on propagation.
maybe if you can add very quickly, you quickly mentioned at the end that there's a possibility to look into demand and supply shocks, which I think would be very interesting. My intuition is that the supply shock could actually transmit more through the input-output structure of the model and perhaps mitigate a bit the benefits of labor reallocation, because you would also have the increase in prices coming through the input-output structure.
Yeah, no, absolutely, and this relates also to Beatrice's question. I mean, this nominal rigidity, whether it's price or wages, are needed because of, otherwise aggregate demand would not have real effects. But it's really important. And actually, the input-output network has focused very much on transmission across heterogeneous sectors in that dimension, how, different nominal rigidities across sectors. That's a very old, actually the multi-sector, non-IO type of literature was very much focusing on that. Yeah, so both shocks, supply and demand, it's true, they will first act, I agree. But then this demand effect will kick out in both cases, but the interaction will be different. And thanks for we haven't thought about using, but there is, the firm part hasn't been explored too much. But yeah, once we get to that, I think using job posting is going to be, and also the, looking at the correlation between type of shocks and position.
And we needed to move to the next paper. Thanks so much for a very interesting presentation and discussion.